let's continue with the buy and sell signals. Now, we left off with the next category of buy and sell signals, and this is what are generally signs of strength or weakness in the market. Mike just finished talking about buy and sell signals revolving around moving averages. Now we're going to talk about elements of strength and weakness in the market. So the first one is the accumulation day. It's a B7. Do not get hung up on the different numbers in that. We had to call them something because we didn't have room in your workbooks to write out the name on all the charts. So just don't get hung up whether it's a B7 or why is it a 7. No reason. It's just where it turned up. Pay attention to the meaning. So it's an accumulation day. Essentially, an accumulation day is an exceptionally strong day in the market. It's going to match the parameters for a follow-through day. So if you're in an environment where 1% or higher represents a follow-through day on heavier volume than the previous day, then any day that matches a follow-through day will also be an accumulation day. But there are a couple of other requirements. There's even a higher hurdle to be an accumulation day than a follow-through day. And those are that the index also has to close in the upper 25% of the day's range, and the close must be above the 21-day moving average. Okay? So if you have a day which meets all those criteria, and it occurs within the first 25 days of a rally, then it's going to be a follow-through day. Okay, we're not going to double count a day that meets these parameters in the first 25 days. It's either going to be a follow-through day, an additional follow-through day. If you get these criteria met beyond that point, then it'll be an accumulation day. In the case of a gap, when the index gaps up from the previous day, the way we are going to calculate the range is we're going to look at the close of the prior day to see what our range is. And there's going to be an example here, so it's going to be clear when we go over some examples. Before we get to the examples, let's talk about a couple of other indicators of strength or weakness. So the next signal is a higher high, a B8. Basically, when the index goes into new high ground, when it closes above a marked high on your chart, it's going to be a buy signal. Now, the way Marcus Smith puts the highs and lows on the chart is it takes each day in question, and it looks 9 days before, and it looks out 9 days after. And if that point on the chart is a high point, it's going to mark it as a high. You're going to see the value of the high of that day on the chart. So when you go close above that level, it's going to be a buy signal. Now, if you have a B8, if you have this higher high buy signal, and you close back below that point, we're going to reverse it. It's going to be a sell signal. That's an S14. So you go above the marked high, it's a buy. You close back down below the last marked high, it's going to be a sell signal. So let's go over some examples of these. So we're in the midst of a downtrend here, and now you're in the midst of a very strong rally. And at this point here, you get this accumulation day. We're out of the follow-through day period. The 25 days have passed, but you have this day in here where you're up 0.8%. Now back in this time frame, you were in a low volatility environment, so the threshold was less than 1% in this time frame. But you can see you close in the upper quartile of the range, and you're well above the 21-day moving average. So that's an example of an accumulation day. We're on page 56.
Charles,
yeah.
You say that the numbers don't matter, but the pairs matter, because 6 and 9 go together and this 1 go together.
Yeah, so the question was that the numbers don't so matter, but the pairs matter. And they do, but just remember, like when we're talking about a moving average, we're really looking at the 21-day, for example, and we're using the 21-day as buy signals and then going back below as sell signals. I guess I just don't want anyone to get hung up with, like, I have my cheat sheet up here too. I can't remember all these things on the fly. If someone's like, okay, B7, what's that? S8, what's that? I have to think about it. So, but if you were to tell me, okay, you know, what are the buy and sell signals around the 50-day? I know that when you break above an uptrending 50-day, that's a buy signal. When you break below it by more than 1%, that's a sell signal. So don't worry so much about memorizing the actual numbers, but it is super important that you memorize the concepts. So there was that accumulation day I was mentioning. Now here are a few more examples of accumulation days. They're grayed out because we didn't need them. They didn't affect the count. We were already fully invested, but that's what they would have looked like. For those of you that came at kind of an earlier iteration of Market School, it used to be that the accumulation day had to occur at new highs, and we changed that. So you don't necessarily have to happen at a new high. In these cases here, they all did happen at new 13-week highs, but on this one, it didn't. So that's a change in the program, and it's actually helped our performance. So here's an example of the higher high. This is the last marked high here on Market Smith. When you close above that level, that's your B8, or your higher high. Here's another example of an accumulation day, and here you break below the higher high. So your buy signal was here, you had another accumulation day here, now you break below that level, so it's going to reverse that buy signal. There's an accumulation day and another higher high.
Is it more of a suspected failure of having sell after a long run and you have accumulation day? I mean, that really a difference at a very long run.
So the question is, if you get an accumulation day well into an advance, is it more indicative of sell signals that may occur going forward? Not necessarily. I mean, I don't think so. I mean, the thing is, when you're in a strong rally, you have no idea of what's possible and how far a rally can go. And in this example here, you can see this is a very powerful rally that stayed well above the 21-day moving average for a long period of time. And if you need more exposure, the system is going to force you to, in a way, stay optimistic until the market starts to break down. Many people would say, you know what, we've run so far, I'm going to wait for a pullback. You can miss out on months and months of performance because you're simply pulling back because it seems like the market's already gone too far. So the whole point of this is forcing you to realize that the market is indicating that it's strong, and it's forcing you to stay in at a higher amount than you may be even comfortable doing if you're someone that's kind of imprinted with bearishness somewhat. They say that you're imprinted with how you first made money in the market. I made money first in the late 90s. So I'm always bullish. It takes a lot to get me negative, because that's how I made money in a bull market. I know people who first made their money after the tech bubble burst, and they made money on the short side. They're always bearish. They're always looking for the next break in the market. So we all have our kind of internal biases, and the point of this system is to try to keep you honest and say, listen, the market's not giving you sell signals, it's acting strong. If you have room in your portfolio, or if our system is saying you're not fully invested and you're seeing signs of strength, it's going to push you in that direction of being more invested. Question?
Charles, when you're S14, when you break below the higher high, you're only going to sell that last group you bought on accumulation?
Okay, so the question was, when you get the S14, how much are you going to back away? We're going to get to how we implement the numbers after I finish this section, so right before lunch, but just to give you a preview, every buy signal gives a value of +1, and every sell signal gives you a -1. So if you, over here, we didn't need that one, but it would have given you, added to your exposure. This is going to give you a +1. That's a -1, so it exactly neutralizes the same thing out. Here you get a +1 on your accumulation day, and you get an additional 1 here. So between these two, your exposure is increased by 2 points. And we'll talk about what that means, actual in portfolio management, when we're done teaching you the different signals. Okay, so let's move on to page 57 and go over a few more examples. So here we have our last marked high over here. When we close above it, it's a buy signal. And the very next day, unfortunately, it's a sell signal. Doesn't always work out. Just because you go to a new high doesn't mean you're going to continue to go to a new high. We don't know what's going to happen. No one can predict what's going to happen the next day. But it's possible that in this case, so here it kind of got you out immediately. It didn't really work so well. But the next time it happened, here, it was the beginning of a great rally here. So you added to your exposure just when the market was taking off. Here are a whole bunch of examples of accumulation days. Some of them we needed were added to our count. Some of them are grayed out because we were already fully exposed at that point. Notice here on this one, this gap up. Remember I told you when there's a gap up involved, we're going to look at the entire range from the prior day's close. So normally when you look at a day's trading range, you look at the high and low of the day in question. So if you look on this day, it's actually in the midpoint of the day's range. But on a gap up, we are going to consider the day before as part of the range. So the range is really from the close of this day to the high of that day. And clearly, when you look at the day before, you're in the upper quartile. So that's when we're talking about gap ups. That's what I meant about the range. Here is another higher high and a break below the higher high. So there it is. The B8 moved above that higher high. Here you failed the next day. And here you had another higher high over there. All right, any questions on those signals? Yeah. On the B8, on the higher high? No. So volume is not part of the criteria for moving over the higher high. Yep. Great question. Question was, how far back do you look? You're looking at the last higher high, or the last high in question. You're not going to, see if we can have an example here. This is your last high on the chart, so the first time you close above it, that is going to be the one you're going to look at. We'll see some situations later when we talk about the lows. You're only looking at the very last high in question. Pretend there was a high up here from before, you would ignore it. We're only looking at the very last one. Yeah.
I'm also wondering, since it's breaking out and it's correcting, but we look at it as accumulating a little more on its head.
Okay, so your question was about trading an individual stock. So,
Well, I know we're following the NASDAQ, but when we're getting out, we're selling our stock.
okay, so the question was basically it's a portfolio management question. We're going to address those questions when we do the simulation at the end of the day, so it's a better time to address that. But the bottom line is this: you have a portfolio of stocks you're holding. When you get a sell signal that tells you you should raise a little cash, you have to make a decision what you're going to sell. You don't have to sell Apple. If you like Apple, you can sell something else. Sometimes what you're going to do is just trim a little bit of everything you have, just to back away a little bit, to move you in the direction that the model's telling you to move. But we're definitely not saying dump your position, you get one sell signal. Or buy this whole thing back, you get another one. You always want to move in a gradual way in the market. But we will get into that a little bit more in the second part of the day. All right, so let's move on to the next signals related to strength and weakness. And so the bad break, or the S10, is basically the corollary to the accumulation day. Accumulation day is an exceptionally strong day in the market where we're going to add exposure. If you get a really bad day in the market, we're going to reduce exposure. Now, the way we define a bad break is that the index has to close down 2.25% or more and close in the bottom 25% of the range. Now, there are two additional criteria. The close has to be below the 50-day moving average, or if that's not the case, the intraday high of that day has to be below the 21-day moving average. And when I show you some examples, I'll show you why that is. Similar to how I define the range on the accumulation day, if there's a gap down on the index, we're going to look at the prior day's close in determining the range. So that only applies if there's a gap down. And then we have the lower low. So just as we buy when we go above a marked high, as defined by Marcus Smith, we're going to sell if we go below a marked low, as defined by Marcus Smith. Each of these are going to be one negative point, -1 and -1. All the sell signals, -1. All the buy signals, +1. Again, on the lower low, the way Marcus Smith is going to determine the low is it's going to look 9 days before and 9 days after. And if that day in question is a low point on the chart, it's going to mark it for you. Okay, so let's go over some examples. We're on page 58. So the rally's just getting started here, and you have this gap down. You close down 2.25% or more. You're in the bottom quartile of the range. you're below the 50-day moving average, it's a bad break. We are not concerned with volume on the bad break, but typically you're going to have heavy volume. But we're not going to require that the volume be heavy. So here's the higher high. We talked about those. Here are a bunch of accumulation days in here. Now, they're accumulation days because 25 days have already passed since the follow-through, since the rally began. Now, they're going to qualify as accumulation days. Here's your higher high, and here's a lower low. So here's your last marked low, as defined by Marcus Smith. When you close below that level as a sell signal, here's a bad break. We didn't need it, it's grayed out. Here's a B7, an accumulation day. Here's another bad break in S10. Here's a day that qualifies as both a bad break and closing below a marked low. So here is a bad break, a bad break. Here's a bad break and a lower low. Notice how you close below this level. The way we define it is you have to close below the marked low. So it looks like you had a shakeout here, but you closed back above it. You have another shakeout, you close back above it, and finally you fail. So that's where you're going to have your lower low. Now, why are we not marking this day here as a lower low? Here's a marked low, and we close below it. Why is that not a marked low? You've already had it. We're only looking at the last marked low on the chart. So I had that question earlier about how far back you want to go for the marked high. The marked high and the marked low for both of these rules are only looking at the last one labeled on the chart. So this one doesn't count anymore because you have one that's happened after that. So we're not concerned with that marked low. We're only concerned with the very last one marked on the chart. Okay, so just a few more examples of a bad break. Here's a higher high. Here's another bad break over here. So I think it's pretty clear what these days look like. And again, I understand there's probably a little confusion, like would I really be buying or selling here? It depends on whether your buy switch is on. And we're going to put the whole thing together for you after lunch. You're going to have the opportunity to actually test yourselves. So for now, the important thing is look at the days in question, how they're marked, and just realize what we're marking here. Here's a lower low, here's a bad break, and a series of other bad breaks. Let's do a few more examples here. On page 59, all of these qualify as bad breaks in the market. Again, down 2.25% or more. You're below your 50-day moving average. You're closing the lower 25% of the range. Here are a number of other ones that we didn't need. We were already out of the market, but we just want to show them to you anyway. There's an accumulation day. There's a bad break. Here's a higher high over here. There's your last marked high. When you go above it, it's a buy signal. It's a bad break. So these 3 days here, this day, and this day, are all down 2.25% or more. They all close in the lower 25% of the range. But we're not calling them bad breaks. Why is that? Right, they're above the 50 days. So here's your 50-day moving average. So they're above the 50-day, and they're also the high of each of these days is above your 21-day moving average. The other one was up here. So what we found was when you're in the midst of a really strong rally, it's not unusual to have a few really bad days in there to kind of shake things up a little bit. And so we don't want to get shaken out simply because we have one bad day in the midst of a lot of strength. And we didn't just say, well, you know, we don't want to act on it. We actually tested it. We back-tested whether or not requiring the stock to be below your 21-day or the 50-day, if that really was relevant. And turned out our performance was better if we did not include bad breaks that were above your 50-day or the high above the 21 days. So we only want to act on these bad breaks, in a sense, when the market is acting overall in a weak fashion. This is a strong rally. We're not going to let a bad day in the midst of a strong rally kick us out of the market. It's going to have to happen later, maybe over here, later in the market. So here's your last marked high. You break below it here. And here are some bad breaks. So over here, we didn't count them, but now the market's rolling over. It's in a weak position. So now that your high of that day is below your 21-day, which is your green line, now we're going to count that as a bad break. Similar here. You're below your 21-day, so now we can count it. We're not going to count them up here where you're above the 21-day, but below here, when your market is in a weak condition, we're going to act on those.
You're not factoring, do you factor probability of failure at a 200-day or not, or are you just looking at the sell signal?
Here's your 200-day moving average. So he's asking about, would you consider this 200-day in resistance in the rally, and would you maybe fail around there? So these are great questions. We're going to talk about that a little later toward the end of the day when we talk about the art. Remember, I talked about the art of trading and the art of market analysis. These are kind of secondary things that aren't part of our model, but you will notice that long-term moving averages are important. So, we do have the 50-day and the 21-day, but we are going to talk a little bit about that later. But yes, as a trader, if I see the index rally up to a declining 200-day moving average, I'm going to be concerned that it might get resistance there. Irrespective of what our system is saying, I know from experience that that's typically a level where the market's going to hit some resistance, and I may back away. And we're going to talk about that in the art. Good question. Here are a couple more accumulation days, and then a few more bad breaks and the lower low.